A line was just crossed. Early this morning on January 3rd, 2026, the United States launched a series of precision airstrikes against military targets in Caracas, Venezuela. Just hours later, the White House confirmed that Venezuelan President Nicolas Maduro and his wife were captured by U.S. forces and have been flown out of the country. While the news networks scramble to cover the political firestorm, the real story, the one that will hit your wallet, is just starting to unfold. This wasn't priced into markets. And here's the dangerous part. The biggest shock won't show up in oil prices first. There's a second order effect already forming that could hit groceries and even retirement funds. And most investors won't see it coming until it's too late. We're going to break down the 5 most critical ways this event is set to shock global markets, revealing both immense risk and incredible opportunity.
Oil is just the first domino. The immediate shock is the price at the pump, but the details are what really matter. Before these strikes, Venezuela's production had quietly climbed back to over 900,000 barrels per day, with some reports suggesting they even hit 1.2 million barrels per day in late 2025. That's not a rounding error. It's a serious amount of oil that has suddenly been thrown into question. Now here's where most people get this wrong. They think this is just a blip because Venezuela's output has been down for years. That misses the point entirely. The initial reaction is a sharp, speculative price spike. Traders don't wait for things to settle down. They trade on the chaos. Analysts are already predicting that Brent crude, which was hovering around $61, could gap up towards $65 a barrel. This isn't just about the barrels lost today. It's about the geopolitical risk premium being violently shoved back into the market. Traders are now asking, will Maduro loyalists sabotage the oil fields? Will the transition to a new government be peaceful, or will it be total chaos? This is made worse by the specific type of oil Venezuela produces. Its heavy, sour crude is not easily replaced. It's a critical ingredient for complex refineries, especially on the U.S. Gulf Coast. A sustained disruption forces these massive facilities to hunt for less ideal substitutes at a premium, tightening the entire global market for diesel and jet fuel. This is a fundamental challenge to the global energy supply chain, and the initial price spike is just the beginning.
Once oil reacts, fear takes over, and fear moves money faster than fundamentals. When a superpower captures the leader of another nation, the old rulebook gets thrown out the window. Fear takes over, and when investors get scared, they run for cover. That means a mad dash into traditional safe haven assets like gold and silver. The logic is simple. This conflict introduces terrifying unknowns. The risk isn't just about what happens inside Venezuela. It's about how its allies, namely China, Russia, and Iran, are going to react. Russia has already condemned the action. While an immediate escalation is unlikely, traders will be betting against the possibility of retaliation, whether it's obvious or covert. Keep this in mind. This becomes critical later. That's why so many are watching precious metals. Gold, which has been trading in the $2,600 to $2,700 per ounce range, is the ultimate break glass in case of emergency asset. Silver will likely surge too. This flight to safety is a vote of no confidence in a predictable world. What's wild is that this entire crisis could eventually crash oil prices instead of sending them higher. I'll explain why later, but first, you need to understand what's breaking right now.
This is shock number 3, and this is where things start to compound.
The fear trade is simple, but this next shock is where the plumbing of the global economy starts to back up. This is the part Wall Street doesn't talk about. To get its super heavy oil out of the ground, Venezuela has to import lighter petroleum products called diluents. Without them, the tar-like crude from the Orinoco Belt can't flow through pipelines. It's like trying to drink a milkshake that's too thick. U.S. naval blockades had already been squeezing these imports, and this new military reality could cut them off entirely. This isn't an oil problem, it's a logistics problem. And logistics failures ripple through everything you buy. Experts warn that if diluent imports stop for more than 6 weeks, production could face a catastrophic shutdown. This creates a double whammy. It threatens the core of Venezuela's production and sends refiners into a bidding war for other heavy crude from Canada or the Middle East. It's a logistical nightmare that ultimately means higher costs for refiners and higher prices for us at the pump. If this breakdown is helpful, stay with me, because the next shock is the one that hits your grocery bill, not your gas tank. This is the shock almost nobody is talking about yet, but it could have the most direct impact on your household budget. This crisis isn't just about oil, it's about food. The conflict in Venezuela poses a direct threat to the global supply of fertilizer, which is the foundation of modern farming. Here's why. Right next door to Venezuela is Trinidad and Tobago, a quiet giant in the global chemical trade. Its Point Lisa's industrial complex is one of the world's biggest producers and exporters of ammonia, a key ingredient for nitrogen fertilizers, responsible for about 5 to 7% of the entire global seaborne ammonia trade. The danger is that the conflict spills over. Any threat to Point Lisa's, whether from sabotage by Venezuelan proxies or disruptions from military activity, would send a shockwave through agricultural markets. A spike in ammonia prices means higher fertilizer costs for farmers everywhere. Those costs then get passed on to you in the form of higher food prices. Combine that with a squeeze on diesel fuel, which powers tractors and transport trucks, and you have a recipe for a new wave of food inflation. This is how a regional conflict becomes a global economic problem. We've covered the immediate shocks, but now for the fifth shock, the one that's completely counterintuitive. And this next detail changes the entire trade. While the immediate reaction is chaos and surging prices, the long-term outlook could be the exact opposite. A successful regime change in Venezuela could eventually be incredibly bearish for oil prices. Think about it. Venezuela is sitting on over 300 billion barrels of proven oil reserves, the largest on the planet. For 2 decades, that potential has been suffocated by mismanagement and sanctions. With Maduro gone and U.S. sanctions potentially lifted, the door could swing open for massive foreign investment. Companies like Chevron could be ready to dramatically ramp up their operations. Analysts estimate that with the right investment and a stable government, Venezuela could boost its output back to 2 million barrels per day in just a year or two. Long term, that could become an additional 2 to 3 million barrels per day, hitting a market that's already worried about oversupply. That's enough new oil to fundamentally challenge the ability of OPEC Plus to manage prices. That's the kind of shift that doesn't just move oil prices, it reshapes entire portfolios. This creates a fascinating, whiplash-inducing dynamic between the short-term bullish shock and the long-term bearish potential. So let's put it all together. The U.S. intervention has triggered an immediate oil price shock, a flight to the safety of gold, chaos in the specialized refining industry, and a hidden threat to global food prices. And, paradoxically, the whole thing might end with a long-term flood of new oil that pushes prices down. What happens in the next few days is critical. The market is balanced on a knife's edge. Markets hate uncertainty, and the next 72 hours will tell us whether this becomes a shock or a full-blown systemic event. And when that line gets crossed, the market won't wait for permission, and neither should you.